Home equity lines of credit, otherwise known as Helocs, versus reverse mortgages. I want to talk about that here for a couple minutes here today because I'm telling you, the more I do research on reverse mortgages, and I'm getting into this because I find it can be very valuable for some retirees, the more I come across the negatives of reverse mortgage and what you need to be concerned with and your options, which some of these guys out there are saying, Dave Ramsey, you should look at a home equity line of credit as opposed to a reverse mortgage because reverse mortgage is a scam. Home equity line of credit is not. My friends, it boggles the mind, the level of just ignorance about how this works. Welcome to Heritage Wealth Planning YouTube channel, my friends, the place where you come to learn everything financial. If it comes to your money, we talk about it here in particular, so don't forget to subscribe. All right, so let's talk about a home equity line of credit, which is a HELOC. All right, just for real simple, you have $100,000. Let's see. I don't have a piece of paper. You got $100,000 home market value. Your fair market value in your house is $100,000. You take 0.7% of that, so 70% loan to value. Maybe some banks might get a little aggressive and give you 80% loan to value. So you take 100,000, and we're going to chop off 30% right off the top. So we have $70,000, which we can use to serve as our home equity line of credit. However, if you have $50,000 mortgage still on it, you only have $20,000 available. Does that make sense? So you have $100,000 fair market value. They're only going to give you 70% loan to value. LTV is loan to value. So take your appraised value or assessed value. Probably won't be your assessed value. You're probably going to need to get an appraisal. You take your appraised value and you times it by whatever the bank's terms are, 70%, 80% loan to value. On a line of credit nowadays, it's pretty tough to get 80%, but let's just say they give you that. But here we're going to say 70%. So you got $100,000, 70% loan to value. That simply means the bank does not want you to have more debt than 70% in order for you to get the home equity line of credit. So in this case, you have $50,000 first mortgage. The max they will let you have to go 70% loan to value is a $20,000 home equity line of credit. Does that make sense? $100,000. You're going to say, we can't give you any more money than being 70% loan to value, which means the max amount of debt you can have is $70,000. You got $50,000 on your first mortgage. We're going to give you a $20,000 home equity line of credit. That's it. All right. Now let's just pretend we don't have a first mortgage. We've got it paid off. All right. So Dave Ramsey says, don't take a reverse mortgage. Go get a home equity line of credit. All right. So here we go. Now, if we have $100,000 fair market value and we have no debt on it and the max the bank is going to let us do is $70,000, all right? So they're going to say, we'll give you $70,000 as a home equity line of credit, considering if your credit's good and all that. You still got to get underwritten. So for that simple, you say, okay, all right, Mr. Bank, I need this because I need income, so $70,000 suits the bill. I have $100,000 as my equity, but I'm going to borrow up to $70,000 against it. Sounds good, right? Well, what do you think the bank is going to charge you for a minimum monthly payment? Most banks, credit unions, most banks, community banks are going to give you a minimum monthly payment of 1% of not the line outstanding, i.e. the debt you owe, but of the entirety of the line amount to get you through underwriting. So they're going to underwrite this case. We're going to go apply for a $70,000 home equity line of credit. The bank is going to say, you need to be able to pay $700 a month to be qualified for that home equity line of credit. All right, so let's just go back to that. $7,000 a month is $8,400 a year. All right, so let's just say you have Social Security and your Social Security pension equals $35,000 a year, and you already got $300, $400, $500 going to Medicare and your Medicare supplemental policy between you and your spouse, whatever. It doesn't matter. At the end of the day, the likelihood of the bank approving you for a line of credit at $70,000 where you can afford to make qualifications a $700 a month payment if you're already squeezed financially, which is the whole reason you're going to borrow against your equity, is nil. They're not going to do it. The only way they'll do it if your debt to income is about 35%. And that simply means for every dollar you have of income, only 35 cents can go out in debt. So let's just go back to the example. You got $35,000 a year of income. That means 0.35. That means you can only have $12,250 going out to debt. So that means that $700 home equity line of credit that's going to reduce by $8,400. So 12,250. Oops, 12,250 minus $840. That means you can only have monthly payments of anything else of $320 on another debt. So if you have a car loan, you got a student loan, you got a credit card, you got a first, I mean, it's insane, the idea that you can just willy-nilly go up to the bank and say, I got all this equity in my home, give me a line of credit. It doesn't work like that because you're not going to be able to qualify for underwriting. If you were able to qualify for underwriting, you probably don't need the loan to begin with because you don't need the income. Debt to income. How much debt do you have to your income? If your debt is $20,000 an annual amount and your income is $40,000, that's a debt to income rate of 50%. I guarantee the minute you walk in the bank, they're going to tell you to turn around. There's no way they're going to touch out the 10-foot pole, regardless of how much equity you have. It's not going to happen. Now, if your debt is $10,000 a year and your income is $40,000 a year, your debt to income there is 25%. You have a little bit of wiggle room, but that 25, that 10% more you can go from 20,000, 25% to 35%. It's going to be very, very tight. And I bet you're not going to be able to qualify for that $700 a month payment. And again, it's not because you aren't going to use it, it's because you could use it. So the bank has to protect their bottom line. They're saying, we are worried that when all the chips are off the table, you're going to borrow 100% against that line of credit and you're not going to be able to have the income to pay for it. And thus we're going to underwrite you as if you're going to borrow the entirety of the line right out the gate. And your 1% is your minimum payment. It used to be 1.5%. So I'm surprised I saw some before I researched this only 1%. That's still pretty hard. So you're like, all right, 1%, $700, but I only need it for $100 a month. They don't care. They're going to say you have to qualify for $700 a month. This is crazy. A reverse mortgage, it doesn't do that. Yes, a reverse mortgage, the closing costs can be higher. Well, guess what? If you can't get underwritten for a line of credit, it doesn't matter what the closing costs are because they're always going to be zero because you're not going to get the loan. A reverse mortgage, if you need the cash and the only thing you can do is sell your house or take on a roommate, for instance, to pay your rent, well, there's an alternative called a reverse mortgage. Is it the best alternative? No. Is it the worst alternative? No. Is it a better alternative than a home equity line of credit that you can't get underwritten for? Yes, because it's never going to happen. You're never going to get that line of credit. It'll never be approved. And I'm looking at all these people. I'm sitting there. I can't believe these people keep saying this. I was watching a guy on YouTube from C-SPAN from the New York Times, saying, oh, the alternative is home equity line of credit. I'm like, no, dude, no, it's not. It's not the alternative. If you're cash strapped, you're not going to be able to qualify. I just can't. It drives me batty, as you can probably tell. And then on top, they're saying, well, a reverse mortgage will put you out if you don't pay your property taxes. You think a home equity line of credit won't do the same? So I'm not here to go in the details of reverse mortgages because I'm learning this myself, frankly. But I am here to say, if I'm strapped financially, I have some equity in my home, I have two choices, a home equity line of credit or a reverse mortgage. Well, the fact that I'm strapped financially just tells me I'm not going to be able to qualify for a home equity line of credit. I'm just not. But a reverse mortgage, I can because it's not based on underwriting for debt to income and all these things. It's just not. They might have some issues in there to make sure you haven't gone back. I mean, I don't know what it'd be. I've never done a reverse mortgage. I don't know what the underwriting is. They just need to make sure how old you are and that you got enough equity in your home. So they're definitely going to charge you an appraisal. Anyway, so the lesson of the story. If you need cash in retirement and you are strapped and you're over 62, that's when the reverse mortgages kick in. You got to be over 62. And you don't have enough income to qualify for a home equity line of credit, your only other option is a reverse mortgage. There's nothing inherently wrong with that. It's not a scam. It's not evil. It's not going to put you out any more than a home equity line of credit would or any more than a first mortgage would. Why? Because you don't pay your tax on any of those, you're going to be put out. The reverse mortgage, isn't excluded from that. Home equity line of credit, a second mortgage isn't exempt from that. And a reverse mortgage isn't exempt from that either. You don't pay your property taxes, they're going to put you out. No other way around that. But if you need cash, you're not getting on a first mortgage. You're not getting on a second mortgage or home equity line of credit. You're only going to be able to get on a reverse mortgage. All right. I hope this helps. It's just frustrating me. And I just had to say this because I'm doing all this research. I'm sitting there. My mind is boggled. So don't forget, if you like what you see here, subscribe. I'm going to have a lot more on first mortgage or reverse mortgages as we go into this because I'm keen on this stuff now. Because I know there are a lot of retirees who are cash strapped financially, but they're sitting on a bunch of equity. I know that for a fact. And a reverse mortgage seems like a pretty good solution to solidify your cash situation, your financial situation on a monthly basis for income. It really does. No, but don't go out and rush out yet and buy that just based on this. I need to learn a little bit more about it. And when I do, I will share it with you. Don't forget Heritage Wealth Planning in the blog. And don't forget the Heritage Wealth Planning or the podcast. You can find that Heritage Wealth Planning too. So we'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.